The market sell-off that we saw last week definitely got people thinking, at least in the short term, about some downside risk in a way that they really hadn't over the past few months. Earlier this year in February, we saw a big decline and a vol spike. This move that we saw was in some ways as dramatic point-wise or similarly dramatic, but it was not accompanied by the explosion in volatility. A lot of that was the mechanics of the trade. The sell-off that we saw late January into early to mid-February was largely because there was a huge short volatility trade out there, and that was let's say the asset class that needed to be repriced the most, and that's why you saw the VIX spiking from almost 10 to call it 40. You didn't see that kind of movement last week. It was more like from 12. At one point, I think we ticked 24, 25 handle, but for the most part, it was 12 to 20. And that's more of your garden variety sell-off. But the question that I raise is, we have a new Fed chairman, and so much of what works in the markets in terms of trading strategies is based off of Fed policy. So let's think about it this way. Buy the dip has been a terrific strategy, more or less for the better part of 10 years. One of the reasons for that was you had a very friendly monetary policy for most of that period of time. It's fairly easy to buy the dip when you know that there's just money coming in behind you supporting the markets. And that works in more or less all asset classes, not necessarily commodities, which are more specifically supply and demand driven, but certainly for any financial product, because the raw material there is essentially money. And what we see differently now is we have a new Fed chairman. Chairman Powell is coming from a different point of view than his predecessors. He's not as academic, he's more business focused. This is not necessarily a good or a bad, it's just different. And markets don't necessarily know how to deal with different. And so that's what makes me think. We always talk about the Fed put, and then it became the Greenspan put, the Bernanke put, the Yellen put. They like to put a name on it, so I'll call it the Powell put. And that the Fed put is sort of the sense that at some level of market decline or dislocation, the Fed will step in and help out the marketplace through injections of money or other accommodative measures. What I think we're seeing a little bit differently is Chairman Powell doesn't seem to want to do that right now. He's on a pace of raising interest rates, and it's not necessarily the wrong pace because we're seeing a very strong economy and we are starting to see inflation, if not become a problem, start to stick its head up a little bit. But we have to wonder, what level does he come in? We don't know. Markets tend to give new Fed chairpersons a test somewhat early in their term. I don't know if this is the test that Chairman Powell is getting right now. It's certainly too early to say because the situation hasn't really resolved itself. But this is really what we have to think about. One of the things that had been, I would say, dampening volatility over the past couple of years, over the past cycle, let's say, is the knowledge that the Fed was there. And you don't really need to buy as much protection on the downside if you think that there's going to be some outside factor arresting any fall in the marketplace. We don't know where that is with Chairman Powell, or even if it exists. So I don't know. Is there a Fed put? If so, is it struck, let's say, down 10% where a correction level? Is it struck down 20% where there's, quote unquote, a bear market level? It's very hard to say. But right now, I think you're seeing a very different tone in the sense that the Fed is continuing to stay on a pace of raising interest rates. They've removed the term accommodative from their language, which the market originally didn't seem to mind, and then a week or two later said, oh, wait, maybe this does matter. And this is all the stuff that's out there. We'll know whether it worked only in hindsight, whether buy the dip works on this particular move. But right now, I think you have to be thinking more broadly of, is the market going to react differently now that there's a new sheriff in town and a much more restrictive monetary regime behind him, at least in the short term?